Hi everyone, this is Demo Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for another video. This one is a financial education video, and today's topic is a very exciting one. It's tax loss harvesting. This is how we basically turn lemons, which is what we've been getting here for quite a while, the last 6 months or so with the market, into a little bit of lemonade. It's the silver lining in this. And so we're going to talk about what this is, when it makes sense, how to do it, how it breaks down, and we'll get all that into that with this video. I hope you guys enjoy. And of course, as always, and I should emphasize this especially with this one, I am not a CPA or a tax accountant. This is something that I'm doing for educational purposes. Please refer to your tax specialist, your CPA, to get into the nitty-gritty of what this means for you. But thanks for watching, and I hope you enjoy it. Okay, let's dive right into what is tax loss harvesting. All right, essentially it's a strategy of where you would sell a security that has a loss. Now, you might say, well, why do I want to sell something when it's down and not when I want to hang in there? Well, yes, that is true. So what you're doing here is you're selling something at a loss to basically reap or harvest the loss, but then you buy something else to reinvest it. So you're not in cash waiting or anything like that. That's not what we're suggesting here. You're repurchasing something else to replenish your portfolio. It has to be something different enough, which we'll talk more about later on, so that you can take the tax loss. Now, it's best to use it when you have short-term capital gains, because short-term capital gains are taxed at a higher tax rate, right? They're your ordinary income rate versus the capital gain, long-term capital gains rates, which are 15 and 20%. So it's usually a higher. So it makes even more sense to use it if you have a lot of short-term capital gains. And of course, if you have losses that you can't offset with gains, you can roll them into the future, which is what I'm talking about here. And you can also take $3,000 if you're a joint filer. If you're single, you can only do half of that. But if you're a joint filer, you can take $3,000 off your income for that current year. Again, that's that higher rate than the capital gains. So that's a very attractive thing to potentially be able to do during the tax year. All right, so let's step back a little bit and talk about when tax loss harvesting is the most valuable. Because if you think about it, a good question to ask is, aren't we just delaying the tax till later by basically taking the loss now when we could have used it down the road? And that is true. But these are some good reasons right here to do it now. Let's say you want to lower your current taxes right away, because maybe right now your tax bracket is higher than it's going to be in the future. So maybe you're earning high earning years now and you're going to be retired later, and that could be one of the reasons. The other reason would be, let's say you have a concentrated position in like Apple stock, and you got a lot of taxes if you were to sell it. Well, if you can harvest losses from somewhere else, you can use those losses to trim down that position and relieve some of that concentration of Apple stock without paying a bunch in taxes. The other thing you could do is you could use it for rebalancing the portfolio. Same thing like the Apple stock. Maybe you have some positions you want to sell, they would be timely to sell, but they would hurt you pretty good in taxes. So you can use those taxes that you saved up from selling things at losses to help you do that rebalancing in a more opportunistic way for the market. And then the last piece here is, getting rid of maybe higher cost funds. I see that all the time. People will come over with mutual funds, but they have this low cost basis. They would have to sell it and pay a lot of taxes. Well, if we can harvest some losses, we can use those losses to offset the gains from selling that fund, and then we can translate it into a lower cost fund for them going forward. So these are some very valuable uses for using tax loss harvesting today. Okay, let's do a deeper dive into exactly how this works. So here's a nice illustration that goes through a process of selling at a loss and then what you do with it down the road. So here we have Joe and Sue. They bought $100,000 in this ETF SPY. And then they sell it, and unfortunately it was down, so they had a loss of $30,000. And so of course they sell it for $70,000, as you can see here. And when they sell it, then they realize $30,000 capital loss. Okay, so then the next step is they then purchase another large cap value fund that increases to 92,000. Again, they invested the 70 and it went up to 92,000 over the next year. So upon selling that fund, they can use the $22,000, which is, 70 minus 92, that's $22,000. That's a gain. So they can use $22,000 of losses from the 30K, right, that they realized before to offset that capital gain. All right. So that means they still have another $8,000 of losses to use up. So they can do the 3K against their ordinary income. Again, it's a couple married filing jointly. They can do up to $3,000 of their income as a deduction to their ordinary income. And they would still have $5,000 left over that they can carry to offset future gains. So basically, they save themselves the $22,000 capital gain. They reduce their income by $3,000, and then they have $5,000 left over. Now, this is, again, a hypothetical. This is not going to apply for everybody. This is assuming that they are in a tax bracket of 30% on the margin, and they're paying 15% capital gains. What you would essentially get here is a $4,200 tax savings, and it breaks it down there a little bit if you want to take a look at that. But that's a nice way to save yourself some taxes now and be able to maybe change a position like we talked about before. But that's essentially how it breaks down. All right, so far this sounds pretty good, right? Well, there is a catch. Unfortunately, there is a catch. It's called the wash sale rule. Okay, the IRS has this rule, which basically means that if you buy back after you take a loss, okay, if you buy back something within 30 days, or even if you bought something before the 30 days that you sold it that is substantially identical to the security you sold, okay, like in that SPY example, if you buy back SPY or if you had bought SPY prior to the 30 days, it's considered a wash sale, which means that you cannot use it to offset your gains and it won't count as a loss. Now, the good thing is you don't lose it. It will just translate the loss into the new purchase, okay? But you don't get to use it at that particular loss until you sell it again and wait the 30 days. Okay, that's what's called the wash sale rule. As you can see here, obviously if you abuse this, the IRS can get on you, fines and restrictions and things like that. So you want to avoid the wash sale rule. Okay, and finally, we need to take a look at, is tax loss harvesting right for me? And as all questions, it depends, right? Depends on your situation. So please, if you're not sure, reach out to a financial advisor, to your CPA or tax accountant to help you with this decision. But here are 4 basic guidelines that I would give you to help you make this decision. So number 1, think about the whole tax bracket today versus tax bracket tomorrow. So if you are in that situation, like I mentioned earlier, the higher income earning years, and then later in retirement, you'll be in a lower tax bracket, that's when tax loss harvesting can make a lot of sense for you. Of course, the reverse is also not as good of a scenario for tax loss harvesting. Number 2 would be if you plan on just holding on to those shares and giving it to your kids as an inheritance someday, or if you plan on using those shares for giving to charities, then it's great to do tax loss harvesting now because you may not ever have to pay the gains that you're accumulating and deferring because you're basically giving it away to charities or your children that don't have to pay the capital gains taxes, right? That's what a step up in cost basis for your children, that's what that means. And then the third one is if you are in a 12% tax bracket or lower, it doesn't make a lot of sense because the 12% tax bracket is that magical tax bracket where you have a 0% capital gains rate. Yes, that actually exists. You can pay 0% in capital gains. So let me know or look it up if you need some help in figuring out if you qualify for that. And then the last one, I won't get too wonky in because this one could be a whole video on its own. But when you take a look at your income, it can affect your Social Security taxation. It can affect your Medicare premiums and also the subsidies that you potentially get if you're buying insurance on the healthcare.gov website. And so all these things need to go into your decision making as far as what kind of capital gains you're going to have and how much to offset and things like that. And so these are the 4 things that I would take a look at and consider when you do the tax loss harvesting. Hope this was helpful, guys. Thanks again for watching, and we'll see you again soon.